Hello and welcome. You're watching ET Markets. I'm Tanya Aneja. Well, there's a tiny difference between living your second innings on a pension and creating exponential 10x wealth for your future. Today, we are going to learn about 10x investing rule and the philosophy of 10x wealth for your family. And to discuss this and much more, I'm going to be joined by a very special guest. We have with us Dr. Mohit Batra, who is the founder and CEO of MarketsMojo. Thank you so much, Dr. Batra, for joining us on ET Markets.
Thanks a lot, Tanya, for having me here. I think it's a great topic to discuss, especially that we are today. I'm very excited to throw some light on and throw some opinions on what we see and how we see the 10x rule playing out.
Absolutely. But before we come to the rule, let me begin by asking you about the current market scenario. I mean, we are fighting with inflation, rate hikes are happening. So going forward, what is your take on the markets? I mean, have we already priced in the worst and are we close to the bottom?
See, it's anybody's guess. I personally believe that if you look at where we are today, I mean, this whole carnage started on the tip of the event of Russia and Ukraine. And post that, obviously, you know, we were long awaiting the interest rate hikes because the inflation number is not something that's just climbed up one fine night. It has taken its time, and we know that a lot of discounting in the price was already happening. But having said that, the market was in a bullish zone, and it was not correcting itself to the news initially. And over a period of time, you'll see these kind of events play out, because there's in any kind of a bull market scenario, when you see an event coming in, there is resistance levels that gets made up out there. Having said that, we've seen a good enough 10 to 12% correction. We are now at, Indian markets are trading at around 19 P, which is in line with the historical Ps, although it is still higher if you were to world. My personal belief is that we are still not at the bottom. We believe that another quarter of pain is there before the pain reduces. Inflation is not something that can get controlled over the next 1 year. There are drastic measures that the Feds would be doing all across the world. Hence, we personally feel that I see another 4-5% from here. I see another 3 months of correction happening till the time that we have inflation and interest rate hikes becoming a part of the market habit. And that's when the revival may happen. We also personally believe that the 2 lakh crores that the FIs have taken out in this calendar year, our estimates say that we may end up on a net positive rather than a net negative for that reason.
Okay.
So last quarter is where the buoyancy may come back to the markets, is what we expect.
Absolutely. All right. Now let's come to the 10x investing rule and learn philosophy of 10x wealth from you. So what are the keys to unlocking the wealth formula? I mean, not just for yourself, but for the generations to come.
So Tanya, I think to understand why a 10x rule is important is primarily to build up a little bit of a context around it. We've been doing a lot of wealth planning for our investors to see, an individual would earn, say, in his full life around 40-45 years of working or business, whatever you may call it, total amount of, say, X. Now, if you were to see discounted for inflation and give the appreciation of salary increases for 40 odd years, what you're typically seeing is the money is not grown in excess of 3-4-5%, which is our Indian habit of parking the money in the fixed deposits. You typically at your retirement are left with around 0.3 of that X. So the first thing that we tell our investors is that at least get the income back, which is income minus any expenses or any income. To get your income back at intervals of, say, 10 years, 20 years, 30 years, and 40 years of your working, we've taken a savings rate of, say, 10%, 20%, 30%, and 40%. Then you'll be surprised that you need at least a 9% to just get your income back.
Okay.
To just get your income back, you need a 9% ROI on the savings that you may do And on an average, you can go from people being different, so it can be around 8% to 10%, but 9% is the holy grail. Now, if you look at return on asset classes across last 10 years, I think equity has been at around 17%. You have gold, which has been at around 12%, equities at around 10%. But having said that, they're all seeing a decline, and that is not a rally that one can believe on. So to continuously grow your income, first of all, you have to cross the 9% hurdle, because that's where you are net neutral to the total income that you earned in a lifetime. At a 20% CAGR, you are at a 10x of your income. So if you were to earn, say, 10 crores or 1 crore or 5 crores in your lifetime, whatever that amount may be, you actually go in and go at a 10x rule at a 20% CAGR. Now, our objective with all our investors is to try and tell them how a 20% CAGR can be achieved over a period of time. So now coming down to the investing rules. The first investing rules is that you need to have the right asset allocation. See, most often than not, what investors do is that they'll park 10%, 20% in a risky asset class, which is like equities. And then they would like it to work much harder, because at a net worth level, they're only 20% or 30% allocated into equities. And even if it grows at 15, 20%, at a net worth level, you end up in single digit returns. So we tell our investors the first rule is very important to get your asset allocation in place, to make sure, decide whether you are an aggressive customer or moderate or conservative, and accordingly get your asset allocation in place, which can be in a conservative profiling around 30% on equities to even go to 100% on the aggressive side. So asset allocation is the key to everything, number one. Number two, there is a kind of a DNA mix that we require for the investors to understand that if there is one thing that we want them to champion across in terms of their habits of investing, is to ride on volatility, because that's where wrong decisions happen. So how to kind of switch off during the times that we are today in and let the money pay out, because a lot of investors take their own personal calls, which may be a cash call, which may be reducing, allocations, which may be selling off too early, which may be, buying stocks which are actually not quality stocks because the price is down in current market scenario. So you catch the falling knives out there. So there are these micro rules that prohibit the customer to maintain a consistency. Volatility, riding the volatility is rule number 2 as we see it. Number 3, majority of the investors, with the new wave of investors that you see coming into this country, the average age of the investors younger by the day. Over the last 2 years, if you've seen close to 5 crore demat accounts being opened up, the average age is around 20 to 28, 30. So people, when they come early on, they need to understand that this is not a quick money making investment opportunity. This takes time. So there's a lot of maturity that is required within the investors, and hence we always say to go with an expert of your choice, who you can trust, who you can depend on, who will give you not just investing products and services, but that investing support emotionally, that what you need to do in these kind of times, and handhold you towards greater participation out there. Number 4th is actually, we, on the contra of what is happening in the markets, we actually tell them to stay away from technology as much as possible. Now, if you see the wave of discount broking that is happening in the country today, which is on a per trade basis, on a per transaction basis, lot of participants on the sell side or on no research side, we have now close to 45 to 50% participation of the equity markets that is happening through discount brokers. Just to save that little bit of money, to go without research, to go in and take your own calls, especially when majority of the investors are very new in the market, is an extremely dangerous thing. So you need to have research support, you need to have experts backing you, and you need to make sure that you're not just trying to do things to save that 10 rupees, 20 rupees, but you're trying to make money, which is in terms of your ROI only focused towards where you can get the best ROIs. And the next one is how you typically concentrate your portfolios to reach to a higher degree of return, which if you have to beat the index, the only way to beat the index is not just to invest in mutual funds, but to have a concentrated portfolio. When I say concentrated, I would typically mean anywhere in between 10 to 20 stocks. As natural habit of a lot of investors on our platform as well, we've seen that they have 50, 60, 70 stocks, and that ends up not making money ever. Even if you see the mutual fund as an option, if you look at the latest PIVA report, which is Standard & Poor Index versus Active report, I think on 13th of April this year, 82% of the large and mid-cap funds, mutual funds, have actually underperformed the index over a 5-year period. So if you have to beat the index, if the index is at 12%, 13% CAGR, and you got to beat the index, then you have to have a concentrated approach of a stock portfolio, which 15 stocks. And then from there, you have to have an expert guiding you in terms of the whole psychology of managing this particular portfolio. It is very widely known that 80 to 90% of your return is not contributed just towards your quality of stocks. It just contributed towards the actions that you take, whether you get into early, whether you get out at a wrong time, whether you cash it out and sit and wait for the bottom to be built up in the market, whether you stay invested. So those are the soft skills which are never taught to our customers when they, our investors, when they typically tide the market. And I think our job has been to tell our investors in terms of what soft skills you need, what behavioral you need to have to be a successful investor. So these are, the broad rules that we discuss out there. And the last and the most important rule is that nobody has been able to make money in the equity markets consistently over a period of 30, 40, 50 years if you do not have two essential commodities, which is patience and discipline. Patience to make sure that you have the courage to, tide over the volatility, and discipline to ensure that you are following the advice meticulously and you are not involving your personal emotions to come and take decisions during such times. I mean, we ask millions of investors today that if the market, they were 6 months back, they were looking at, can they get in 10% cheaper? Today, the markets are 10% cheaper, maybe another 5% from here, 7%, who knows? But if I were to advocate a philosophy of trying to get good, portfolios, good stocks at this price, I think there's no better time, especially over the next 3 months, if there is, any correction coming in. But that is easy to say, easy to read, easy to understand, to comprehend, and very difficult to actually execute in real day-to-day life. And that's what these rules are about.
Absolutely, Dr. Batra. Actually, couldn't agree more. Investors should have, I think, patience and discipline, especially at this point in time. And also, if someone is planning to put 10 lakh rupees right now, so which is the ideal medium according to you, and what should be the asset allocation strategy?
See, asset allocation strategy is typically very dependent on the client's risk profiling and risk appetite. So there cannot be one generic answer to it. But let me just pick up the case of an aggressive customer or a moderate customer. A moderate customer typically should look at least a 50% participation in equity markets, and remaining 50% in debt and fixed income opportunities. I do not take FDs as a debt opportunity. I think parking money in fixed deposits is the safest way of losing it. Parking money with the bank is the safest way of losing it as far as investment return and ROI is concerned. So if you were to look at building up a 10 lakh portfolio today, and if it is an aggressive customer, I would typically say that invest 2.5 lakhs each in concentrated model portfolio over the next 4 months, not as an SIP, but as you take in today, and if you feel that the market dips another 3-4%, you get a bunch of 2.5 lakhs, and so on and so forth. So it is not a time-based investing; it is a milestone-based investing. That if you invest today, and if you feel that the market is correcting further, you put in the next tranche out there. So 10 lakh can be invested over the next, say, 4 odd months with extreme discipline of fall in the markets. The portfolio is what I feel should be the need out there. If you were to look at a broader asset allocation on moderate, where you're talking about a 50% equity, which I'll follow the same route, but if you're talking about a 50% debt opportunities, I would look at AAA rated bonds on a smaller duration. I would look at a couple of years of maturity or 2 to 3 years of maturity. I'll not play long right now on the bond yields. And there you have a chance of making around 6% post-tax. So that is, typically 50% more than the money that you earn in your fixed deposits in the bank. So I would say that play the short-term bond strategy if you were to look at a moderate profile, but please play the 3 to 4 month allocation strategy with 10 lakhs on equities if you were to look at getting extremely good prices over the next couple of months.
Absolutely. And on that wonderful note, thank you so much, Dr. Batra, for taking the time out, sharing your valuable thoughts. Thanks a lot.